In this week's video, we'll review some key economic drivers dating back to the financial crisis to help us better understand the key drivers for stocks and bonds in 2023. We'll be moving quickly, so feel free to use the pause button on your video player. Let's start with a tweet from the second trading day of the year, January 4th. At the end of the year, there really wasn't a lot to get excited about in terms of the market's tolerance for risk. But as we covered in last week's video, it appeared that was starting to shift in a meaningful way the first week of the year. In this week's video, we'll examine some of those recent shifts, some of the shifts that appear to be taking place early in 2023, in the context of what happened last year, with the real motivation being, what can we learn that may help us in 2023 and beyond? And to really understand where we are today, we have to go all the way back to the early 2000s, really with a focus on the post-financial crisis bull market. It was the highest closing price in the S&P 500 in January of last year, or January of 2022. This is the lowest intraday low down here in October. The drop from this close up here in January to this intraday low in October was just over 27%. And unlike the COVID plunge, there was a lot of volatility and counter-trend rallies between point A and point B. As you can imagine, if the market fell pretty much in a straight line all the way down to point B, it's a lot easier to manage risk relative to big counter-trend moves, big drops, big counter-trend moves, and big drops. As we mentioned 2 weeks ago, last year was very unusual. Tesla down 65%, Apple down 26%, and everything shown on your screen here down somewhere between 20% and 67%. The former bull market leaders, tech and growth stocks, hammered. And your typical safe haven TLT, even worse than the S&P 500, down 31%. We covered these charts in last week's video. The Nasdaq made a new closing low for the bear market on December 28th. And that's important because if the market leaders are to continue to rally, for the most part, the Nasdaq has to put in a low for the bear market to be over. It's highly unlikely that the Nasdaq is going to continue to fall for the entire calendar year in 2023, and the market leaders are going to move in this direction. So even if tech and growth are laggards, it's still important relative to how much risk we should be taking. And you may remember last week we said one of two things is going to happen. Either the Dow's chart is going to morph into something that looks more like the Nasdaq, or the Nasdaq's chart is going to morph into something that looks more like the Dow. On the back end of the video, we'll talk about that topic and what transpired this week. And reviewing history and last year will help us understand these shifts that we talked about in last week's video, potentially very significant shifts, especially from a leadership and asset class perspective. In the next segment of the video, we'll focus on these bullet points, and then in the back end, we'll focus on these bullet points. In early January 2023, the trend in stocks is down, and the longer-term trend in interest rates is up. If we review stock and bond returns dating back to 1871, it's pretty easy to make the case that 2022, in terms of a combined return, was an extreme outlier, and for the most part, the worst year ever. Typically, if you take the time to try to better understand what transpired during difficult periods, it will help you to more readily identify future opportunities. And at some point, this bear market will end, and at some point, good things will happen. In April of 2022, Jamie Dimon said that we were presented with completely different circumstances than what we've experienced in the past. And that will become crystal clear after we take the time to review some key developments between 2008 and the end of 2022. Let's start with the concept of quantitative easing. In September of 2008, Lehman Brothers filed for bankruptcy, and eventually the Federal Reserve decided to move to an ultra-loose monetary policy, announcing QE1 on November 25, 2008. Without getting into the details and the complexities of QE, just think of it as lowering interest rates on steroids. Thus, when the new bull market started in March of 2009, central banks were as powerful as they had ever been and had two new and relatively unconventional policy tools at their disposal: large-scale asset purchases, QE, and forward guidance. Probably fair to say that large-scale asset purchases and/or the announcement of QE1 in November of 2008 took monetary policy to an extreme. Common economic sense tells us that negative interest rates also fall into the extreme category. In 2012, Denmark became the first country to adopt negative interest rates. And at that point, for the most part, it was only a matter of time before it was going to become difficult for bond investors at some point in the future. While you really don't hear much about it anymore, modern monetary theory, on the back of quantitative easing and negative interest rates, started to get some mainstream traction. This article is dated March 21st, 2019, from Bloomberg. Modern monetary theory proposes that a country with its own currency, such as the United States, doesn't have to worry about accumulating too much debt because it can always print more money to pay interest. The next sentence foreshadows where we are in the present day. So the only constraint on spending is inflation, which can break out if the public and private sectors spend too much at the same time. Quantitative easing, an extreme. Negative interest rates, extreme. Modern monetary theory, relatively extreme. And then came a global pandemic. And as we all know, the pandemic brought lockdowns and major disruptions to the global economy, for the most part in the form of supply chain issues. And it's probably fair to say that unprecedented global stimulus fits in neatly into the extreme policy category. And that unprecedented stimulus came in the form of both unprecedented and unlimited QE, monetary policy, and never seen before government spending, fiscal policy. Remember, according to modern monetary theory, a country with its own currency, such as the United States, doesn't have to worry about accumulating too much debt because it can always print more money to pay interest. And while there was no formal adoption of modern monetary theory, it's pretty easy to see that it did have some influence and fit in nicely with quantitative easing and the concept of negative interest rates. And all with good intentions during a very, very difficult time, a global pandemic. We have the Fed engaging in unlimited asset purchases and the government sending out checks. And we can also throw into the mix a major shift in Fed policy. USA Today headline, upper left-hand corner of your screen, dated August 27, 2020. Fed announces landmark policy shift to spur inflation and job growth, keeping rates low longer. Text on the right side of the screen over here comes from the Washington Post. Federal Reserve Chairman Jerome Powell on Thursday announced a major shift. The new approach signals that the Fed won't increase interest rates to respond to low unemployment levels, meaning an economy that is potentially overheating and typically could cause inflation, and it also won't worry as much about low rates triggering a rise in prices. So in August of 2020, the Fed announces that they're going to de-emphasize part of their dual mandate, which would be price stability, and they're going to emphasize getting back to maximum employment. And very much like the well-intentioned policies on the other side of the global pandemic, this was a well-intentioned policy trying to produce a broad-based recovery and trying to help as many Americans as possible. From the Financial Times, the Fed also reframed its views on maximum employment, stating that the goal is now broad-based and inclusive. And as we all know, after the major shift in Fed policy, inflation did start to take off. And as stated in March of 2021, the Fed thought that they were transient effects, aka transitory inflation. May 11, 2021, Fed's Bullard says it's too early to talk taper while pandemic continues. What the Fed believed was that on the other side of the pandemic, the supply chain issues would tend to work themselves out, and more people were going to return to the workforce, and thus inflation would back down. Unfortunately for all of us, it didn't work out that way, and eventually the Fed started to admit in late November of 2021 that they had a problem. Thus, coming into 2022, we had QE1, negative interest rates, the pandemic, followed by unlimited QE, an unprecedented and importantly synchronized global stimulus. So everyone's sending out checks for the most part, and everybody's printing money. They're all doing it at the same time. And then the Fed announces that for the most part they're going to put inflation on the back burner. And they thought inflation was transient in nature, and thus for the most part they ignored it. And when Powell kills transitory in late November 2021, for the most part, that's forward guidance, so they're really starting to pivot to a tighter policy. Now, even though inflation was running hot, the Fed didn't end QE. They were still conducting QE into Q1 of 2022. And when inflation really started to take off, the Fed had to raise rates at the fastest pace in 35 years. This excellent graphic from McKinsey & Company helps us understand just how much stimulus was pumped into the global economy. The black circles show the 2008 financial crisis. The blue circles, COVID. Germany, Japan, France, UK, United States, Canada, India, South Africa, and Brazil. And unbelievably, this chart is only dated June 11th, 2020. Governments allocated $10 trillion for economic stimulus in just 2 months. Thus, with all of this, and a lot of positive factors such as demographics, in late 2021 and in January of 2022, we had one of the strongest trends in history. S&P 500 here, December 3rd, 2021. Here's your trend. Here's your trend in 1995. So when the Fed starts to pivot, we have incredibly strong trends, and trends that historically would be extremely resilient. And this type of trend is typically associated with very shallow drawdowns, and drawdowns that typically in duration are very short. And we knew in Q1 of 2022 that if the bull market ended, it would be the shortest bull market since World War II. Thus, relative to history, the trend didn't look like we were in big trouble, and the duration didn't look anything like we were in big trouble. And as most of us know, extremely low interest rates tend to favor tech and growth stocks. And that has to do with a discounted cash flow approach to valuations. When you invest in tech in a lot of cases and in growth companies, you're really buying a promise of future earnings. And when interest rates are low, those future earnings are more valuable. And when interest rates start to rise, those future earnings become less valuable. Thus, with all the extreme policies and admittedly situation, we also ended up with extremes in relative performance. So when we come into 2022, the relative trend, XLK Tech divided by the S&P 500, is so strong, and it's really so strong back here in 2020, on the back end of all the stimulus in here. Look how strong the trend is. If we fast forward to January of 2023, that relative trend, it's taken almost 3 years for that extremely strong trend to roll over. So in some respects, when we're in here, we're looking at, with the benefit of hindsight, somewhat of a false look or false strength, or a market that historically looks like it's going to be susceptible to very, very shallow drawdowns. And even with high valuations in tech and growth stocks, we all know from history sometimes those trends can be extended and they can go on for years. We ended up having the shortest bull market in duration since World War II. And in the first half of 2022, we get to a point where inflation is just not letting up. And the Fed does a 180, and then they slam on the brakes. So we've got all of this over here, all of it extreme in one direction. Then the Fed slams on the brakes faster than any other time in modern history. Here's the pace of the rate hikes in 2022, 1994, 1999, 1987, 04, 06, 2015 to 2018. So we go from one extreme to the other extreme. You can see it down here. This is the 32-week rate of change of the money supply M2. It's Goes back to 1959, 1960 here. Look at the rate of change of the money supply during the COVID stimulus here. It doesn't look like anything that we've seen historically. And then the Fed slams on the brakes and we plummet. And thus, it's not particularly shocking that we see a headline like this at the end of 2022. Wall Street's top stars got blindsided by the 2022 market collapse. We're still dealing with extremes. This is an extreme here. It's not even close to anything that we've seen in the rearview mirror going back to the late 1950s, early 1960s. And if you look down here in the present day, now we're at the other extreme. Now they've slammed on the brakes so hard that the 32-week rate of change is negative. Never happened before. Look in the orange box. We never go negative going all the way back to the late 1950s, early 1960s. One extreme to the other, and we did it very, very, very rapidly. All right, in the middle of all of this, February 24th, 2022, Russia invades Ukraine and commodity prices spike, helping push inflation to another extreme. 2022 inflation kept hitting 40-year highs. Headlines on your screen: October 2022, July 2022, June 2022. This is from the end of the year, speaking to U.S. and global inflation. And it almost felt like during 2022 that a lot of the wild swings and counter-trend moves, straight up moves and straight down moves, really just didn't need to happen. Chairman Powell did a good job delivering the core message in many instances, but he also slipped up on several occasions and just threw gasoline on the volatility fire. Here's an example, June 2022, quote from Bloomberg. The stock market rally after Fed Chairman Powell suggested that jumbo size increases won't become the norm. There was some confusion as to whether or not that was a pivot, and then there was short covering, and in this case, eventually, we rallied about 19% from point A to point B. And probably the most misunderstood or misinterpreted comment or misstep from Powell occurred on July 27th, right in here, where he implied when the federal funds rate was only at 2.25 to 2.5% that they were near neutral. And that sent a message to the markets that, hey, we're almost finished. After this statement here from Powell on July 27th in the press conference, the S&P 500 went almost straight up, tacked on an additional 400 points from here to here. And for the most part, this highly puzzling comment here about being near neutral and this 400-point rally in the S&P 500 triggered all kinds of breath thrusts. The market went crazy. They thought the Fed was almost finished. And breath thrusts had been, for the most part, the most reliable signal in the bull market from 2009 all the way up to the end of 2021. So we get the Powell-induced breath thrust here. And historically, really, really good things tended to happen. For the most part, the S&P 500 was higher a year later. The average gain was about 25%. 2 years later, 39.25% on average. 100% of the cases, the market was higher. And we said this was the most puzzling comment, and we weren't the only ones that felt that way. Larry Summers said that Powell's comment was indefensible. Summers said, Jay Powell said things that, to be blunt, were analytically indefensible. There's no conceivable way that a 2.5% interest rate in an economy inflating like this is anywhere near neutral. But that was after a 400-point rally and after a wide range of breath thrusts were triggered based on numerous indicators. And while Powell hinted that we were near neutral or close to being finished in July, Bullard came along later in the year and said, rates probably have to be, in terms of becoming restrictive and above neutral, somewhere between 5 and 7%. For the most part, more than double the levels that Powell referenced on July 27th. And while the Fed tried to bend over backwards in their messaging in this October 21st plant article in the Wall Street Journal, not to spark a rally, it didn't work. Rally from point A to point B here, 17.45%. After this article was published, the S&P 500 tacked on an additional 435 points. Now, it should be noted, and noted correctly, that every single market participant had to deal with all of this, and hence, why it was an extremely difficult year for many market participants. and ended up being an extreme outlier relative to history dating back to 1871. And for a good part of the year, while the Fed was sending somewhat confusing messages at times, inflation was still hovering around 40-year highs. Remember the Jamie Dimon quote from April of 2022 that we covered in April of 2022? Ties in nicely to this headline from December 12, 2022. Inflation was so bad that it even crushed inflation-linked bonds. Now, these overextended relative trends made it difficult for the market model. Things that worked extremely well between 2009 and the end of 2021, things that were your friend, in some respects were harmful in 2022. So between 2009 and the end of 2021, for the most part, every time you took an ETF and divided it by XLK, SCHG, or the S&P 500, it was very, very difficult to find anything that was stronger, and that was helpful during that period. In here, these relative charts, because the trends were so extended, and we can make a case at least partially artificially extended, they made these assets appear more attractive probably longer than they actually were. And as we mentioned, the relative trends didn't work nearly as well in 2022 as they had in the past. And this is possibly the thing that made 2022 the most difficult relative to managing risk and managing portfolios. This asset class performance here in the 2000 to 2002 dot-com bust bear market. The S&P 500 peaks on March 24th of 2000 and bottoms on October 9th, 2002. The S&P 500 loses approximately 50%. TLT gains 38% plus. IEF gains 41%. Gold up double digits. There were logical places to hide. Defensive assets worked well. And that's what the market model does in a traditional environment. When the trends start to roll over, the relative trends, the S&P 500 divided by TLT, it starts to migrate to defensive assets, something that typically adds value. Same thing in the financial crisis. S&P 500 peaks on October 9th, 2007, finds a bottom on March 9th, 2009, and loses over 50%. Between point A and point B, TLT up 25%, IEF up 20%, gold up almost 24%. The safe havens were safe. Not only were they safe, they were extremely profitable. And what that allows you to do is offset some of the drawdowns on this side. And if the trends are long enough and the duration is long enough and the magnitude is big enough, you have a chance to make money in a bear market. These are big moves. And it's not shocking that it didn't work out this time because the problem was inflation and the Fed raising rates rapidly. So in this case, the S&P 500 lost roughly 20%, TLT lost almost 30%, and IEF was down 14.36%. Gold was positive for the year, but that's even a little skewed because it was up nicely early in the year, and then for the most part it gave back those gains. And it may be even more important to look at it this way. We don't get much change here when we look at the max gain, meaning bonds were profitable during the entire time. Not so in the financial crisis. So between point A and point B, the maximum gain in TLT during the bear market was over 46%. IEF almost 26%. GLD almost 36%. Once again, giving you an opportunity between point A and point B during the financial crisis bear market to not only offset some of these drawdowns, but to possibly profit handsomely. And you didn't have to do anything too fancy. Just had to own boring government bonds and possibly precious metals. How do these numbers look in 2022? Well, TLT never gained any money during the year. IEF never gained any money. And as just mentioned, GLD did pretty well the first half of the year, first quarter or so, and then it was pretty much all downhill after that. And stubbornly high inflation and rapidly rising expectations for short-term interest rates presented completely different circumstances than we'd experienced in the past, and that was true for everybody. It was a difficult year for everyone. From the market model's perspective, this is the most significant difference between this bear market, and 2022. So the concept of nowhere to hide applied. Also saw some odd things relative to the VIX And we had an explosion in short-dated options that, for the most part, threw gasoline on the volatility fire. In more than a handful of cases, we had short squeezes that, for the most part, were on option-induced steroids. And a big part of the volatility was the short-dated options and the obsession with the Fed possibly pivoting. Couple that with some shaky communication from Chairman Powell, and we had a lot of wild swings, which is admittedly not particularly abnormal for a bear market. Some of the factors contributing to those swings were a little bit different. Asset allocation didn't work particularly well. Some major failures on the breadth thrust front. A lot of sentiment-based tools didn't work nearly as well in 2022 as they had in the past. And as noted on the right side of your screen, going back 5+ decades, we had an unprecedented combination of volatility and weakness. A lot of professionals and a lot of top analysts found that things they typically relied on didn't work particularly well in 2022. Now we'll shift gears and we'll look at the topics that we talked about last week, see if they continued into this week, and see what all of it may mean for 2023 and beyond. Market breadth, the NASDAQ. This is daily new highs minus new lows. This is the highest level here in early 2023, going all the way back to the beginning of calendar year 2022. For the most part, that's a divergence. The S&P 500 was all the way up near 4,800 back here, and yet this breadth indicator is higher today than it was back here, and the S&P is still below 4,000. Technical analysis, we're looking for subtle shifts. This concept is tied into this chart that we've covered many times. It's trying to turn. If a new bull market's going to start or has already started, the NASDAQ really needs to start to rally. This is during the session on January 12th. This is a little bit of an improvement here. You can see prices down in this area. We do have momentum saying be open to a move. Stock market bulls would like to see a lot of charts, including the daily chart for the NASDAQ, get to the other side of these trend lines. Similar situation here. This is during this session on Thursday, January 12th. A lot of good things are happening, including price consolidating above the moving averages. See this in here? This is different from anything that we've seen in here, telling us there's a higher probability of moving in this direction. That may or may not happen. And the weekly cloud during Thursday's session, trying to flip from red to green here. Similar situation here, consolidating above the 200-day and 50-day, telling us there's a higher probability of breaking out above this area of prior support, which may now act as resistance. Hasn't happened yet. If you look at the weekly chart, this looks different here than anything we've seen going back here. And if we look at the daily on a closing basis, this is during Thursday's session on the 12th, you can see we are trying to exceed this trend line, and we have cleared some important levels down here. Here's another chart. The daily cloud looks better, and it looks different than anything that we've seen in the rearview mirror. Comments here about being higher than any point in 2022, somewhat of a bullish divergence. I believe we tweeted this chart during the week. The concepts, exact same concepts apply. This is January of 2022. This is this week. This is a strong look here with the Bollinger Band. Not checking all the bullish boxes, but looking better than any point looking backwards from calendar 2022 for the most part. As of the close on Thursday, January 12th, there was a battle here. Last week, the bulls won it. We closed above this battle area in here on Thursday. Again, telling us the probability of breaking out over here eventually is increasing. We still have to do it. Very similar concepts here. Notice MACD is turning up, gets a bullish cross near the 0 line. That's better than anything we've seen in the rearview mirror going back to January of last year, telling us the probability of a breakout is higher now than, for the most part, than it was here and here, where momentum was starting to wane when we got up there. Now it's turning up. Never a bad thing when you're trying to make a stand above an upward sloping 50-month. We've talked about this ratio in the past as being concerning. This ratio has been climbing for quite some time. This is discretionary relative to defensive staples in the small box. You can see the S&P 500 is trying to make a stand in an important area, and momentum gives us a chance to clear it. A weekly close above this level, 4072, would improve bullish odds. This is during Thursday's session. We'd also like to see RSI clear these levels here. A lot of stock-related weekly clouds are improving. If you examine the daily cloud chart for the 10-year yield, this is when the S&P 500 was falling and yields were rising. This is starting to look different and a lot weaker over here. This is favorable for risk assets. The daily chart of the 10-year yield, if we compare the vulnerability here to here, we do look more vulnerable here. So interest rates and the weakening of the US dollar are relevant to a lot of big picture issues. Similar situation here. The 2-year yield speaks more to expectations about the Fed being close to being finished. This looks weaker than any point shown on your screen here. Price below the daily cloud. Cloud is flipped from green to red. Price below both blue and red. Blue, very, very close to crossing below red. This is the first time the lagging span has been inside the cloud and below price at the same time. Interest rates and the US dollar. If the dollar remains weak and interest rates roll over, that tends to favor foreign assets over US assets. The charts are starting to reflect some improvement. We have some breakout looks, clearing levels that we've been unable to clear in the past. Doesn't predict anything, speaks to odds. So in the first part of the video, we talked about US-centric for the most part. SPY, XLK, growth stocks. So either VUG or SCHG. Very hard to beat. It's possible all of that is reversing. Foreign stocks have been major laggards. It's possible with all these shifts they're going to lead. Resistance in 2018, resistance in 2020. This is a good risk-reward entry point the longer that we can hold above these levels. This is that nice look with the 30-week moving average. We want it to turn up. It looks like we've gone above it, somewhat of a retest. And if this holds into week end, this is on Thursday, at the close, we would be making an important higher high, a high also above this level and this level. Notice momentum, different from anything that we've seen in 2022. Also an improvement in momentum here relative to the rear view mirror. This is a weekly chart. We also have cleared some levels on the daily chart that we were unable to clear in recent months. Have the turning look here in emerging market stocks as well. Very, very similar look here. This is foreign developed markets. Think EFA. This is Vanguard's VEA. So this is a subset of this, and this, for the most part, is a subset of this and this. So as you're getting more specific here, the weekly cloud chart of the Euro Stoxx 50 index, again, looks better than anything that we've seen recently. If you look at these bullish signals down here, we're checking a lot of the boxes as of Thursday's close, including the weekly cloud flipping from red to green. Not as much improvement here in the U.S. because the U.S. has been lagging, but still discernible improvement. This is a risk-off look here in the bond market in August. You can see we might be drifting from that script. This is IEI divided by IEF. This is IEI, 1 to 3 year Treasury bonds in isolation. Once again, this looks better than anything that we've seen in the rear view mirror. It's subtle, but it's an improvement, and it speaks to the potential for a return to risk on. There was a divergence at the October low, shown on the Twitter feed. Now there's a divergence here. We're making a higher high with leveraged loans. The S&P 500 has not yet cleared this high. This is telling us clearing this high is a higher probability now. This type of movement here, shorter term bonds, now underperforming longer duration and riskier bonds, a basket of bonds. This looks more like risk on. This looks more like risk on. This is high yield bonds. This is going back to January of last year. Again, looks better than anything that we've seen. This is HYG. This is the daily cloud. JNK weekly, better than anything we've seen looking backwards. Not out of the woods yet. This is potential resistance, but significant improvement. Similar situation here. We would want JNK to outperform conservative and short-term BIL when we're moving to risk on. We didn't have that before. It's possible we're shifting now. There's a big battle line here on mid-caps trying to break out as of the close on Thursday. Economically sensitive and interest rate sensitive home builders. Highest level that we've seen in a long, long time. This goes all the way back to February and March of last year. Above the 200-day in red, above an upward sloping 50-day in blue. Momentum turning up above the zero line. Here's the COVID low in the S&P 500, SP low volatility, conservative relative to RSP equal weight, crosses the 200-day moving average in the S&P 500 rallies. In early to mid-January, ratio is below the 200-day. You can make an argument it's similar to this point here. Credit markets, corporate bonds, you can say that's a left shoulder. This is a head. This is a right shoulder type look. Been talking a long time about how the credit markets probably need to steady themselves. This is the major low in the S&P 500 in 2009. Notice when LQD is back here months ago, it's below all of the moving averages and the slopes are all down. Now it's in the same general area trying to break out, but this looks a lot more constructive in here with this tight cluster. Momentum also positive. Typically when you get up here, you rally. When you get up here, you rally. Doesn't predict anything, speaks to odds. We'll cover this look here in a moment of the triple Qs. Trying to make a stand now at a logical area from a volume by price perspective, also getting somewhat of a tight and coiled look. This is the weekly momentum look here. This is also telling us to be open to a move in this direction. Open to, not predicting. Triple Q's also trying to make a stand at the 50% retracement of the COVID low A to B move up here. This is the 50% level here. This is the 200 week in brown all the way out to the 250 week in silver. We got extended from it. We've come back to it. There's that nice momentum look here telling us we need to be open to this market moving in this direction. Similar situation with XLK. You can see momentum here telling us to be open to a move in this direction. Hasn't happened yet. If you're a stock market bull, regardless of whether you care about the QQQs or have exposure to them, you would like this low to hold. Equal weight S&P 500 weekly during Thursday's session speaks to improving probabilities and an improved look. Equal weight S&P 500, think lower exposure to tech. 30-week moving average turning back up. Price went above it, came back towards it. It's possible we're going to print a higher high. If we can clear this level, that's a good step this week. Momentum down here crossing the zero line, and this look here says we should be open to price getting out here. SCHM divided by SPY, mid-caps divided by the S&P 500 in the ETF world. This is a risk-off look here. This is where the NASDAQ peaks. This is risk-off. This is a risk-on rally here in 2020, and this is the COVID low here. This is the move that we've seen recently as of Thursday's close. We've been consolidating for almost a year, maybe longer, and this is before bank earnings on Friday. We've been covering this for a long time, the 30-week moving average, starting to have that type of improved look. If we zero in on that 30-week moving average, this is as of Thursday's close. It's trying to turn up in a constructive manner. This is during the session on Thursday. This is the close. Monthly, also a constructive look here. This is telling us if we can hold these levels, this would be a good risk-reward entry point. Notice the term risk is included in that. And in this case, your left shoulder, your right shoulder, and your head, it looks like the neckline here would be sloping upward in a bullish manner. You get a V look here near a low, somewhat of a V look here near a low, and in every case, you retake the 50-month moving average as we have in the present day. RSI back above 50 here, at least as we speak now on the monthly chart. Copic curve trying to turn back up longer-term momentum in a constructive manner. This is your major low in February of 2016. This is where global stocks start to rally and find their footing near the 2011-2012 retest look in here. This is the chart dated December 30th, told us to keep an open mind to a wide range of outcomes, including bullish outcomes. It's still sending the same message. This is as of 3:53 p.m. Eastern Time on Thursday. This is a defensive bullish breakout for defensive assets, starting to look like a failed breakout XLP divided by SPY. Similar look here, SP low volatility defensive divided by SPY. All three of these charts are saying the same thing, just on different time frames and with different instruments. The longer these looks hold, the more relevant they become. Covered this last week. This was the look near the COVID low. This was the look as of January 6th. Last week, this ratio was down almost 1.6%. This week, as of Thursday, it's even lower, down 2.83%. A lot of these extreme policies in here swung the pendulum towards tech growth and the S&P 500. It's possible the shifts away from tech growth and the S&P 500 have further to go. Recent tweet here. The median PE of growth stocks in our universe is 113% above its long-term mean. The median value stock is 12% below the long-term mean. What does that mean? It means tech and growth, and for the most part, somewhat the S&P 500, could still be considered way overvalued relative to value stocks and possibly foreign stocks. These bullet points are from a week ago, January 6th. This range broke to the upside in favor of the bulls, and the range above it that we've covered on Twitter in the weekly videos as of Thursday's close also broke to the upside in favor of the bulls. And most of the improving charts that we've covered in the last 2 weeks align with a logical and rational story of new potential long-term leadership. And as we just covered with valuations, it's possible that the margin of safety in those stocks will be much more attractive relative to the old leaders, for the most part being the S&P 500, standard weight, growth stocks, and tech stocks. Again, bullet points from January 6th. So far this week, as of Thursday's close, the NASDAQ has been moving towards the look of the Dow and value stocks. The longer that continues, the more relevant it becomes. Just as maximum flexibility has been very, very helpful in the last 2 weeks, we all know the only way any of this is going to work is if we head into next week and every week with that flexible, unbiased, and open mind. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or an offer to buy or sell any securities or any related financial instruments, nor should any of its content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shivako Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.